Beautiful thing about tax season is when you account for everything that you've done up till the 31st of December, or in certain circumstances up till the last day of the month of February. So really, it's not about what happens in those 2 months, March and April. It's what happens way before then. So this is basically a wake-up call to say, hey, if you're not thinking about it, this is the time to grab the opportunity and take action before it's all gone and before all the time is done. Ty, is that right?
I agree because one thing we know in North America, there are two certain things that will happen: death and taxes.
You're correct.
Yes.
Um,
So sure as sure as what? Sure as the
as the
wind
sun rises.
as the sun rises, you will get taxed and you will pay taxes, and and that's it. So we're not gonna die, but we're gonna pay taxes. And we'll pay it next month. Sorry, next year for 2 months, 3 months we'll do taxes, right? And
Yeah, yeah.
so we're
So
here
our
to
goal
talk about
tonight is basically to draw your attention to the relevant things that you need to keep in mind. We from our experience working on the tax clinic last year. Personally, for me, it was the first time doing income taxes for lots of low income people, and I could see the clear difference. Doing taxes for somebody who earns $45,000 and less, comparing that with somebody who earns between $50,000 and $130,000, and that's also very different doing taxes for somebody who earns $200,000 and above. And that's my own experience as a tax preparer speaking
and
right there.
by the time you're $1 million, you need a lawyer, a tax attorney.
Well, definitely. Well, actually, I think you need your tax accountant and your lawyer working hard with you by the time you hit the 250K mark, because by that time the CRA has their hands firmly in your pocket. Your effective tax rate is closer to 40%, and who wants to give away 40 cents on every dollar they make? That sounds like a sorry story, right? So you really want to know how you're protecting yourself and ensuring that you're getting the best bang for your buck. So, Tayo, without taking too much time, when it comes to low income, based on our experience doing the tax clinic last year, what are the key pitfalls that we saw low income people make? Particularly the ones where people who earned less than $60,000 were having to pay back taxes to the government.
Simple. They did not plan. They did not plan for their taxes. There's this a wild misconception out there that says that if you don't have money, don't plan your taxes, right? Don't plan at all. And I find one of the biggest things I found that was disconcerting when people didn't plan, and they didn't keep documentation.
Yep,
Mm.
yep,
But
yep.
so planning, tax planning, it's not illegal to plan your taxes, right? Some, people, you work in 2 jobs, 3 jobs, even though you are being paid little amounts in this job, you need to make sure that your employer is deducting taxes. What's the box 22? Um, the tax box, the one that has
Yeah, yeah, yeah. On
box
your T4
22
slip,
on your
make sure
T4
that
slip.
number isn't zero.
Make sure it's, make sure it isn't zero, especially if you're working 2 or 3 jobs or 4 jobs, right? Even if your total income there is less than 10,000, because you say, well, if it's less than 10,000, I don't pay taxes. The problem is you don't pay taxes on one job, on one T4 slip, if it's less than 10,000. But if you're working 4 or 5 of those jobs, in aggregate, it becomes 50,000. And if you've not paid taxes in all of them, guess what
Ooh,
happens to you? You
yep,
will pay taxes.
yep,
You're a
yep.
single man, you have no children, you're by yourself,
Ooh,
you're fighting single, and you've worked 3 jobs. You've worked as a contractor, you have a T4A slip, and you have no number in the box 22. It's going to be a problem. You will pay taxes. So you should tell your employers to deduct taxes, talk to your HR, take taxes. Even if it's $50, or you know what, if they're not going to take it, save the money. So when you do have to pay it back,
exactly. Sock
you
money.
have it.
Sock
Save
money
some
can be
money.
used to pay taxes.
You know, some money, do something about it, plan for it, because once again, it will happen. Another thing that can help you is charitable contributions. Your
Tayo, I
church.
don't want us to even go away from that scenario. I want to make sure that that scenario is clear. So,
Okay.
guys, the scenario we are describing tonight is I work minimum wage, so my employer does not deduct taxes, but I have 2 or 3 of those jobs, and I work all of them consistently all year long. On each job, I'm making $15,000 to $20,000 or less, but I have 3 of them. So individually, if you work to one of those jobs, yes, by the time we take your personal allowance and a few deductions here and there, you may not be liable for any taxes. However, when you work 3 of those jobs and you have a total of between $30,000 and $45,000 earned in the course of the year, yes, you are still at the lowest possible tax bracket. But guess what? It's 15% of whatever you have left after we've taken the personal allowance and any other deductions that you may have. So when you are in that situation, your employer hasn't taken any taxes, you suddenly find yourself having to cough up a decent chunk of money sometime in April, somewhere between $1,000, $1,500 and $2,500. That can be really very upsetting.
It's
So
very
we're
heartbreaking.
saying, if you are in that scenario, it's one or two things. This is November. You can still get your employer to take that money off 3 paychecks, right? And then you would pay the rest. But you will need to save that money, because I guarantee you're going to be owing taxes unless you are doing something really, really good, which means you are planning, which is what this entire conversation is about, right?
Planning for your taxes. So, thank you. That was very well said. And so, the next thing you can do is charitable donations. The government of Canada is such a wonderful government. They want you to support your charitable causes. So, they give you almost a dollar to dollar match, I think, as a refund. No, not necessarily as a refund.
As a reduction of
As a
your income,
reduction of your income.
up
Most of the
to
time,
the
it translates to a
maximum
refund.
of 75% of your earned income. So if you earn $10 and you make donations of $8, the government will allow you to only take 7.5. If you earn $100 and you give out $80, the government will only allow you to take 75, right? To a maximum of $75. But what they will do is they will say, hey, you earned $100, you give away 75, so they're going to treat you like you earned only $25. And that's how it works. So whether you earn a lot of money or earn a little money, any money you give to a charitable cause, that is an organization that is recognized as a registered charity
in
by
Canada.
the Canada Revenue Agency. So you can't give money to your church, back home in Africa, in Nigeria, or some boys and girls club somewhere in Europe. As long as if they are not registered in Canada, they are not a registered charity, you will not get the deduction. But if you give that money to any charitable organization that is recognized by the Canada Revenue Agency and is on the list posted on the CRA's website, then you will get that. You'll be allowed to take up to a maximum of 75% of your income off as a tax break, because you said you've given that money away. Now, if you make that donation and you don't have sufficient income to claim that donation, you can claim it. I'm not sure whether it's a year or 2 years or 3 years, but you can claim it in subsequent years as long as there's documentation that you've made the donation.
So you carry forward. So the point is, make sure when you go to your churches, your mosques, or your organization and you give money, take the tax slip they give you, fill out the envelope. What we find is a lot of people didn't fill out the envelope, and you hear the comments like, I gave it to God. Yeah, but God doesn't spend dollars. You gave it to your church, church use it for God. Bring the tax return, the tax receipt, use it for your tax return. Now when you get that money, go back and give it back to the church.
Go back and give it to your church again. So that way
or your mosque, or wherever you're giving it to. So let's be practical about those things. Fill out the envelope, fill out the forms. This is not your home country where those things don't matter, right? The Lord looks upon the heart. Okay?
Exactly.
So fill it out, bring out the documentation, receive your tax receipt from your organization that you're giving it to, and bring it for your tax filing. So save it, take a picture of it, let them email it to you. If you've not done it for the past 2 or 3 years, go find it, go collect it. It will help you. Number two, RRSP. That one was especially painful for me because a lot of people work in organizations where they offer RRSP, match, even on match RRSP, but they have the facility where they'll take the money out of your bank account and they'll save it for you. A lot of people didn't take advantage of that. Why? They didn't know what an RRSP is or was or is. It's a tax tool. It's a tool. The financial. How do I say it? The financial.
Okay, so let me take this off you. An RRSP is registered retirement savings plan. It's basically a plan put together by the government of Canada to encourage Canadians to save towards their retirement. Now, how do they encourage you? They say every time you put $1 into your long-term expense, your long-term living nest egg, we will take $1 off your income in the year that you earned it, based on when you made the contribution and based on the contribution room that you have. So everybody that works in employment, take note, I said employment. Everybody that works and gets employment income has RRSP contribution up to 18% of their total earned income for the year. Employment income now, not business income, not capital gains or losses, not property income. Employment income up to 18% to a maximum of I think it's indexed for inflation every year. So I'm not sure whether it's hit the $30,000 limit yet. But the last time I checked, it was somewhere between the $27,000, $28,000 cap. So if you earn $300,000 a year, your 18% is not 26,000, but all you can take is 26,000 or 20, whatever that number is, somewhere between 26 and $30,000 right now. So the government will allow you to reduce your income by that number. Now, because your employer has deducted taxes from your income at the full amount, a contribution to an RRSP based on your contribution room oftentimes results in a decent refund. Now, how do you get the cash to fund your RRSP contributions? Well, one, you can save the money. Sock money. Sock money is good to saving for retirement. Nobody likes to hear that, but it's the truth. Number two, you can borrow money from the bank. All the banks have products where they will lend you money to fund your RRSP at prime rates. So you have an RRSP, you borrow money from the bank, you fund the RRSP, you get your refund, you use the refund to pay back what you owed the bank, and that way you now have long-term money saved up for you. Which other way? Those are the two primary ways that I know that you can fund your RRSP. Tayo?
I like the option of just saving little by little whenever you get an opportunity. And that's why I like the employer plans and even the ones through the bank. You set it up, they take $100, $50, $20 off your paycheck. You don't even see the money go straight to your RRSP account. It's there. And and you do that every paycheck. Eventually it adds up to something. And then when you get the decent refund back, you can put it back again into the RRSP to grow, right? So those are wonderful, wonderful things that people did not take advantage of last year that was particularly heartbreaking for me, that I feel people should have looked into. So I think that's enough for the low income, modest income segment. If you want
there's one more thing I want us to talk about.
We can't tell them everything.
No. This one is very important. Tayo. This one is very, very important. It's called the RRSP trap.
Pray tell.
So now, for everyone who has an employer who contributes to their RRSP as a matching, there's a need to be cognizant of that employer contribution, because what the contribution does is that it takes away your contribution room without giving you the tax benefits. So this is a scenario. Your employer says, I will give you a 50% matching on your RRSP. So you tell them, oh, take $50, take $100 off every paycheck for the year. And what that does is over 26 paychecks, your employer has withdrawn $2,600 from your account. And they've matched that $2,600 50%. So you don't have a $2,600 contribution, you have a $3,900 contribution. But guess what? When it's time to file your taxes, you're not going to get the benefit for $3,900 that's been contributed. You will get the benefit for the cash that came out of your personal account. So in the event that you are the kind of person that waits till February and you want to top up your RRSP and max it out, you say to yourself, oh yeah, I've contributed $2,600, so therefore I can take the full maximum amount. No, you cannot. Your employer has used $1,300 of your contribution room, and as long as your what it will happen is, if you max out your contribution room, you would have over contributed to your RRSP, and that is a 1% penalty for every month that you over contribute. Now, basically what that is you are just going to pay money. The CRA is going to penalize you basically for over contributing to your RRSP. As long as our over contribution is more than $2,000, the CRA will be penalizing you every month that you maintain an over contribution. So to avoid that, keep your employer contribution in mind when you are making your RRSP contributions, if you're in a matching situation. And with that, I am ready to rest my case on low income and mid income taxes.
And I should just say the term low income is not meant to be derogatory. It just means the bracket with which the government describes certain income rates or income levels. That's just what that is. What are we talking about next?
Well, income for the big boys. When you earn $200,000, $150,000 and above, what do you do about your taxes? What should you be doing?
They should contact us. At Tayo at Dexteritas.ca. That is my because they can afford to pay the consultation fee at that point in time.
Of course they can.
Why is that? Because every situation is different, and it's difficult to speak to people. See, thank you, Tayo at Dexteritas.ca. Dotun at Dexteritas.ca. Contact us, give us a call on all the social media handles. Dexteritas at Dexteritas. I can't remember which one is which, but
at Dexteritas, at Dexteritas Inc. At Dexteritas1 on Twitter, at Dexteritas Inc. on Instagram, and at Dexteritas on Facebook.
Yes. What I would say though is, if you're earning the big bucks, keep your documentation. Keep it well. All the money you spent on the property you bought, every penny you spent. If you work from home, keep your documentation. Know how many percentage of your house you used for your home office.
Yes.
We can't give it all away right here, guys. You have to understand.
No, this is quick tips, but definitely if you work hard for that money, you want to pay your fair share of taxes and no more. And it makes sense to be informed and to be aware and to plan for it. So,
are there any new changes that happened this year that the government has?
Actually, this year has been fairly active on the personal tax side. One thing that I know has been out there is the luxury tax, the luxury car tax. So for high income earners, you buy a car, I think the limit is $100,000. When you buy a car that's that expensive, the government is going to make you pay a tax for it. And that's the reality that we are dealing with at the moment. So that's one of the changes that occurred this year. In addition to that, on the corporate tax side, when it comes to claiming capital cost allowances on motor vehicles, the limit you can claim on a passenger vehicle has increased from $30,000 to $34,000. In addition to that, the government they are putting their money where their mouth is as far as going green is concerned. So, for example, if you bought an electronic vehicle this year for business purposes, you'll be able to write off as much as $59,000. I say that again. You will be able to write off as much as $59,000 because you bought an electronic vehicle, an EV, rather than an internal combustion engine car. So those are some of the changes among a plethora of others, but there are definitely a rush of changes to personal taxes this year, and it just makes sense to be aware of them so that you can properly plan and put yourself in a position to make the most of those changes to your benefit.
I'm curious as far as we're giving tips. Does everybody know that if you're buying a home, you get your GST back if you buy under 450,000? Is it 450,000?
It's 450,000. I think it's 450,000. That's correct. That's correct. So when you buy when you buy a principal residence for under $450,000 and it's a brand new house, right? Typically, the contractor is obligated to collect GST. But if you buy a house under $450,000,